I think once this really gets looked at, sounds pretty cool to just say 999, but at the end of the day, it is a big tax increase on some people out there that vote, that care, and I think it's going to be tough sledding for 999.
Finally, Rick Perry is right about something. In the spotlight tonight, the income tax increase in Herman Cain's 999 plan. Last night, the current Republican frontrunner ran the numbers on how much a median income family will pay in federal taxes under his 999 plan.
A family making $50,000 a year, which is around median income, under the current system, they're going to pay $10,200 in taxes. Under the 999 plan, they're going to pay $4,500 for that middle nine, and that leaves them $5,700 to apply to sales taxes that they would pay on that third nine on food and shelter. And then if they buy goods, no taxes on used goods.
All of that sounds good if you've never seen the tax return of a family making $50,000 a year. Joining me now to check Herman Cain's math, Washington Post columnist and MSNBC contributor Ezra Klein. Thanks for joining me tonight, Ezra.
Good evening.
All right, Ezra, TurboTax this thing for us. The family of four making $50,000 a year. How did Herman Cain's numbers sound to you?
They don't sound all that right, actually. Look, let's just back up for 1 second before we get into the nitty-gritty. What Herman Cain is doing, he's saying he's got a revenue-neutral tax plan. So that means it can't be that everybody gets a tax cut because we're raising the same amount of money. He's got a revenue-neutral tax plan, and he's just changing the distribution. And the way he's doing it is he's replacing a series of taxes that tax rich people at a higher rate than poor people, the income tax, the corporate tax, things like that, with a set of consumption taxes, what's called a value-added tax, basically, on businesses, and then a sales tax on everything else. Now, folks who have to spend their incomes in a year, folks who actually have to buy things, folks who make $50,000, they pay consumption taxes at a greater rate in a single year. So he's taking taxes that tax rich people more and replacing them with taxes that tax poor people more. There's no way that folks on the bottom half of the income scale are getting a tax cut under that. Just no way.
Well, let's go through the numbers of how it would actually look for a family of four with a $50,000 tax return. What would they be paying under current law?
Right. So for the $50,000 family, under current law, they pay on their own side of the payroll tax about $3,000, $4,000. If you add in the employer side, which you should do, remember the employer pays about a 7.5% payroll tax on your earnings too. You're dealing with about $7,000 in payroll taxes.
Let's hold it there because that's an important question. Herman Cain keeps saying that he's using the total number on both the 7.5% that you pay on your end, and he's adding into that the 7.5% that employers pay. It is arguable. He's assuming that if the employer did not have to pay that in Social Security tax, the employer would immediately hand over 100% of that without even being asked by the employee. That is a huge assumption. The employer might hand over none of it. So the only thing we're absolutely sure of is that the worker pays 7.5%.
Right. So there are those taxes, and that's the bulk of what a worker ends up paying. But the other piece of it is that under the federal income tax, that worker isn't going to pay much at all. Imagine dealing with a family of four. You've got a standard deduction that's about $11,500 off. Then you got four personal exemptions. It's another $3,000 or so per of those. You get 2 child tax credits. You add all that up, you got another $800 in federal income taxes. It's not all that much. So if you add in the employer side of the payroll, the employee side of the payroll, and the federal income, and I had Ed Kleinberg, a tax attorney or tax lawyer at USC, help me out with this. The family of four with $50,000 is paying about $8,300 or $400 a year in taxes. Now you go over to Herman Cain's plan, and Herman Cain's plan, it's very vague and very complicated. In particular, the business tax is not a corporate income tax. If it was, Herman Cain's plan would raise about half as much as the current tax code, and we'd have the largest deficits in American history. But it isn't. He says it's revenue neutral. We take him at his word. What he's got is essentially like a sales tax on businesses, something they have in Europe a lot, a value-added tax. That's at 9%. Then you've got one on the sales tax side. Those are essentially the same tax done twice. It's like an 18% sales tax for people, then even 9% personal income tax. Now, it's the way you get to, it's a tax rate of about 26, 27%. The way you get to that is not just adding them all up. It's a more complicated calculation that happens to come out at 27% or 26% due to some revisions Kleinberg sent me today. But when you put it all together, the way he would put it is it's like a 26% payroll tax with no exemptions. So that same family is paying around $12,000 or $13,000. It's a $5,000 tax increase on them.
We're not going to hear that math from Herman Cain. Ezra Klein of the Washington Post, thanks very much for joining me tonight.
Thank you.